4 signals, 4 pillars really, that will get an investor to say yes. As a reminder, we're in week 3 of the 30-day founder blueprint. We're talking all about funding. Yesterday, we talked about pitch decks, how to build one, what the structure should look like, what slides should look like. Today, we're focusing on this idea of traction and how to demonstrate the right traction to get an investor to say yes. Traction is not just a number. It's not just a thing. It can be a variety of things. And the traction that you had can vary depending on the stage of your startup. If you're a very early stage, traction will look like one thing. If you're in growth stage, it'll look like a totally different thing. So to an investor, traction is just evidence that you're able to execute on your story. So it could look like, it means to them things like the market cares, the product is essential, the business model works, you're on the right team, all those different things. What they don't want from you is just a data dump of numbers. They want a clear, tight narrative around what you're doing. And so we're going to look at these 4 signals. Signal number 1 is what I would call revenue integrity. So this is the most powerful signal because unless you're a nonprofit, you're here to make money. And so when you're making money, it's a really good signal to investors. And they can spot what's called flimsy revenue. I see a lot of flimsy revenue in the startups that I work with and that I look at from an investment opportunity. Revenue integrity is very, very important. There's 2 key things that you've probably heard talk about before. These are MRR and ARR. MRR is monthly recurring revenue. ARR is annual recurring revenue. Sorry about that. And so, for example, a Series A, ARR might look like $1 to $2 million per year in annual recurring revenue, right? This is a sort of a signpost that things are going in the right direction. And it could include a growth rate, right? Now, what they will do is it's not just about that number. Remember, I said this isn't just a data dump. They will look at that number and see how you compare to other startups at similar stages in the similar industry with similar products. Maybe their ARR is 5 million. The question would be, why aren't you closer to that number? Another really important number is net revenue retention. And so this is a gold standard. This means if you have 100% NRR, this means your existing customers are spending more over time than you're churning. Okay, so net revenue retention is very, very important. In this whole section, when you're looking at revenue integrity, this is really all about showing that you have high quality recurring revenue. It's really important to focus on, okay? If you show up for an investor and you go, oh, we've got revenue, and they go, how much? And you go, $5,000. They're going to go, not so much, right? So you want some good historical monthly recurring revenue and preferably annual recurring revenue. Now, you're thinking to yourself, well, how can I get there if I don't have capital from an investor in the first place? Could mean that you're not ready. Could mean that you need to figure out how to be more creative and bootstrap a little bit further before you raise money. Okay, so these are the signals that you got to think about. Signal number 2 is engagement. So in lieu of revenue, I would take some significant engagement numbers. What does that look like? Core metrics could be DAU and MAU. So if you're a SaaS solution, DAU is daily active users, active being key. MAU is monthly active users, right? And you want to be able to show that there's stickiness and growth there. So for daily products, 25% could be considered a healthy DAU, right? If you're over 50%, if 50% of your users are active on a daily basis, that's pretty good, right? And I think we see things most likely places like Instagram, Facebook, places like that, okay? So signal number 2 is engagement. We want to see engagement to get an investor to say yes, okay? If people have signed up for your product and then they're not actively using it, that's not a good thing, okay? So signal number 3, unit economics, okay? This is really important. So there's 2 big ones I want you to focus on. Talked about them, I think I've mentioned them briefly before, CAC and LTV. CAC, customer acquisition costs, LTV, lifetime value. These 2 work together in a ratio. So if your customer acquisition costs, let's say it costs you between ads and onboarding and all these things, let's just pick a number and say it costs you $25 to get a new customer. If your lifetime value is $5, that's not good. That means you're spending more money to get a customer than you're making, not just in the beginning, but in the entire lifetime of a customer. So you want to look at CAC and LTV ratio. For every dollar you spend, preferably multiple dollars of return, even in the early stage. So 2, 3, 5, 10, 25 ratio. As it grows, that means you're getting a better understanding to how to acquire customers affordably, and the lifetime value of them is going up as well. CAC payback period is really important too. This is how long it takes you to earn back your acquisition costs. So if the LTV is 25 and your CAC is 5, you look at that ratio and it really, really matters. So that's signal number 3 is unit economics. The last signal is market validation strength. Okay, so there's a couple of ways to show it, and I'm going to break this one down based on phase. If you're early stage, something like a growing wait list, we talked about using landing pages to capture emails. A growing wait list could show successful pilot or beta process. And another example with early stage companies that I see, which is very strong in lieu of revenue, is LOIs, letters of intent. So let's say that you're going to sell B2B, business to business, and instead of revenue, you don't have that yet, but you can show that you have 10 signed letters of intent from prospects that plan on buying the minute your product is live. That's a really good market validation strength signal for an early stage company. For a growth stage company, it could look like diversity of your customer base. You could use logos to show market validation strength. So logos, when that's said, it's not your logo, it's the logo of companies that are your customers or have signed your LOIs. And then go to market. You could show scalability across multiple channels. Maybe you did some campaigns on Instagram. You know what your CAC and LTV is off of there, but now you're transitioning onto TikTok and you're going to leverage that. You've got some numbers to show there as well. So these things with market validation strength, what they show that we've sort of talked about before is this idea that you found a pain point and it's a big market and you know how to solve it and you know how to solve it in multiple ways so that you can grow and become a market leader. So the key is with these 4 things is that you're showing not just one data point of traction, preferably multiple data points of traction to show the investor that you know what you're doing, you know how to execute on your plan, and all it's going to take is additional capital to pour into that plan to make it scale at the pace that you would want to go at, that an investor would want you to go at so that they can get the return they're going to get. So just to reiterate them real quick, one last time: revenue integrity, engagement stability, unit economic soundness, and market validation strength. You're not just asking for a check, you're asking for fuel to go faster. Get that in your head when it comes to funding. Most people show up and want to talk to me about meeting investors, and it's all about money, but that doesn't mean that that money is going to become fuel to go faster. Really, a lot of times they're asking for money just to get started, and for most investors, 99.9% of the time, that's just not going to be enough. You need to get more traction going. These are the types of traction you have to show, and you will improve your chances of getting a yes.